Now, Miss Ann's story is pretty simple here. Her father had a life insurance plan, his only life insurance plan, left in a trust. He left her mother as the trustee. Don't know the amount of insurance left, but from what I understand, it was a very small amount. Now, Miss Ann goes on to explain here that it's been upwards of 6 weeks since they've initiated the claims process and have yet to receive their funds, which is throwing a wrench in the funeral plans and keeping her mother financially solvent during this waiting period. Now, why would somebody want to leave a life insurance policy in a trust? Several reasons actually, but we do it for a few common reasons. The first is to preserve the deceased estate. In the state of Maryland, any estate valued over $5 million is going to receive up to a 16% estate tax rate. Anything over $13.61 million is then going to receive an additional estate tax of up to 40%. If you're married, both of these estate valuations can be doubled before you are assessed a tax. And what an irrevocable trust can do, and yes, irrevocable, not revocable, those two distinctions are very important. It can remove that money from under the ownership of the insured, therefore no longer being a part of the estate valuation. But because ownership is being removed, you actually also no longer have access to that money while living. So what people will often do is take a life insurance plan out and the value of the projected estate tax due, place it into an irrevocable trust. That way they still maintain control of the money, and there's a way to pay for the tax when it gets left. There's a few people commenting here saying, well, life insurance is tax-free, so that shouldn't have mattered anyway. This is not totally true. Life insurance is income tax-free, but it is not estate tax-free. Accumulated value of your estate will include any life insurance death proceeds, which is why you wouldn't just leave the policy to your beneficiary. You would remove it from under the estate and put it into a trust, thereby not having the money that you want to use to pay the estate taxes also be a part of the estate tax calculation. Now, we use those same removal of ownership aspects in our irrevocable trust to help people gain compliance in order to qualify for Medicaid. For us, this often includes cash value accumulating policies. Again, we would put that into a irrevocable trust. And lastly, trusts are a great way to direct the usage of that money. The trustee can only follow the directions of the trust and how that money is to be released. So when you have a family member with special needs or a disability who needs care for in the future, this is a great way to ensure that that will happen with the money you're leaving. Fortunately, like Miss Ann said, with small amounts of insurance, this becomes almost not worth the hassle. Setting up a trust in general is not cheap. One of the reasons she's most likely having trouble getting the money and had to hire the expensive services of attorneys is because the claim process for a person versus a trust is very different. Trust will have to provide different documents in order to verify its legal existence. My hope and how we function here at Bay Life Brokers is that if you're working with an insurance advisor to set up this type of plan, that advisor is also working for you when that plan needs to be claimed upon. And this should be done at no extra charge, which is why it's important to place your policy with someone who's ethical and who's going to be around for a while.